I think what we're learning because of FTX is how much more important fully transparent, decentralized networks will be to financial services going forward. FTX, Celsius, 3AC were all closed networks, opaque systems. You couldn't see what was going on. And what happened as they were going down, people who were on the fully transparent, distributed networks were able to get out scot-free. They saw what was going on. There were margin calls for those who were over leveraged, but the system worked. It didn't skip a beat. Those other companies went out of business. It's a little bit like 0809. The old financial world is very opaque, not transparent. The new world that we're entering, and we do believe DeFi will actually get a boost coming out of this because it's so obvious now. Decentralized and transparent is the way to go. Those networks didn't skip a beat. All of the transactions were completed. And there are all kinds of metrics saying they're getting stronger now. It's very interesting to note that Sam Bankman-Fried, who has either committed gross negligence or outright fraud, he didn't like Bitcoin. He didn't like it. And why didn't he like it? It's decentralized, it's fully transparent, and he couldn't control it. He was trying to control the crypto world, master of the universe. And that was a recipe for failure. It's been most unfortunate because so many people have been hurt because of it. But I do think the big lesson, and even the newest SEC commissioner is saying, you know what? We really have to double down on this idea of decentralization and transparency and help to propagate this new world with the right kind of regulation. And it's not like they have to change regulations. As Brian Armstrong says at Coinbase, we don't need new regulations. We need clear regulations. And we certainly need more clarity from Gary Gensler at the SEC. And the other thing we need, I would submit, is we would have saved a lot of people from some of the catastrophe that FTX has presented them with something like a Bitcoin ETF, a regulated. Instead, a lot of people went offshore and then got carried away with it. So I think the SEC deserves some blame for what has gone on as well.
Yes, as we're thinking about this question, we compare what Chairman Powell is doing to what Chairman Volcker did in the late 70s, early 80s, when he was fighting an inflation problem that had been building for 15 years. Vietnam War, Great Society, closing the gold window. That was a real inflation problem that built up over 15 years. This inflation problem has been 12 to 15 months by the time the Fed started addressing it. And we think it's much more a function of supply chain imbalances caused by COVID and then again by Russia's invasion of Ukraine. These are very, very different circumstances. So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%. And that's a 16-fold increase. What did Volcker in the early 80s? He took interest rates from 10 to 20%. That's a twofold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. And I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained. And if we see an increase in GDP, it's probably because either inventories are continuing to increase or imports are coming down as companies try to unwind their inventories.
Well, I do believe that the stock market has been discounting this for a good part of this year. The market is in a bear market. So the equity market's not going to be surprised. And even the fixed income market's not going to be surprised. The yield curve, so the difference between the 2-year and the 10-year treasury yield, is over 80 basis points, 0.8%. This has not happened since the 80s, the early 80s, when Chairman Volcker, was taking a sledgehammer to inflation, an inflation problem that had built up over 15 years. years. This inflation problem built up over 15 months. And instead of increasing interest rates twofold, 10 to 20%, which is what Volcker did, Chairman Powell has taken interest rates up 16-fold. Again, never seen that before. And I do believe that the surprises now are going to be on the low side of inflation expectations, dramatically so. We believe that inflation will drop below the Fed's 2% inflation rate sometime next year. And the pipeline is telling us that. Commodity prices, inventories, which are overwhelming and causing all kinds of discounts. And the bond market itself, whenever there's a yield curve inverted, it is saying, okay, growth is going to disappoint or inflation is going to be lower than expected or both. Well, if you look at what has outperformed in the last year or so, we've seen the beneficiaries of inflation outperform. Now, I just told you that oil prices have come down from $130 to the low $70 range, almost cut in half. And yet the XLE, the S&P energy sector index, is not that far from all-time highs. So there's a bit of a disconnect there. What you will see as inflation unravels, interest rates come down, raising the present value of future cash flows. That kind of environment benefits our portfolio. We have stocks in our portfolio, companies that are going to be extremely profitable in the next 5 years. Right now, they may not be that profitable because they're investing aggressively to capitalize on some amazing opportunities in the genomic space, robotics, energy storage, artificial intelligence, blockchain technology. They're investing now because many of these are going to be winner take most markets. So they're huge markets. And therefore, there's latent profitability. The gross margins in our portfolio, so just taking cost of goods sold from revenues, the gross margins are very high. I think a change in rhetoric toward, hey, maybe we're not going up after 4.5%, or change in rhetoric will get the market going. The market is trying to figure out how high is high. And you've got some observers, economists out there thinking it could be 6 or 7%. And so the market is holding back and saying, wait, we need some evidence. Now, I think the evidence is becoming very strong because long bond yields are down at 3.5%. The long bond market does not think interest rates are going to 5 or 6%. It's been moving in the opposite direction. We got up to 4.25% on the 10-year Treasury, and now we're down to 3.5%. So the bond market, I think, is speaking pretty loudly, and the bond market itself, which would be the most sensitive to rates going up, is moving in the other direction.